For example, Aura and the company today has gotten an audit of Safari Park Hotel. Of course, at Aura and the company, which is a registered audit organization, audit firm based in Westlands, we have other clients. When we onboard a new client, his audit will always be taken like a project with us. If it's a project has got three key phases. We have what we call planning. You must plan, you must execute, and then you must do what we call reporting. Now, during planning, if it's a construction company coming in this case here to construct a house of a client, this client, even before he chose a contractor, he must have done his plan. He must have known, I need a bungalow, I need a maisonette, or I need this type of a house. The client must have sat down with the architects. The client must have sat down with the quantity surveyor, basically for them to come up with those architectural, structural maps and what we call a quantity survey report, what we call bills of quantities. It is after that they bring now a contractor to build, to execute. As the contractor is executing, the contractor and the person we call a clerk of works will be doing what we call giving out of reports to the owner and to any other stakeholders, including the county governments, etc. There'll be a lot of reporting. The same case is applicable to audit and assurance. If I'm appointed today to come and audit Safari Park, I'll have to do a plan. The plan, we normally do what we call the overall audit strategy. And then number two, we do, in this case here, the detailed audit program. Yeah, from there we go to execution. At execution, what do we do? Two things. I will do what we call the test of internal controls, a must. Test of internal controls for me to be able to know what kind of substantive tests will I be able to apply when I'm testing the numbers. So execution has got two areas. We have the testing of internal controls of a company, and then we have now substantively looking at the numbers in the financial statements. I've already finished the internal control section. Now I'm looking at what we call the substantive tests. This takes me to lesson number 24. Lesson number 24 is what we are doing here. And don't mind, even if you haven't been with me, I'll be able to tell you what you need to do to get access to these lessons. So lecture number 24. Yeah, lecture number 24. Lecture 24. This is where we are. Great. Great. So lecture 24 is where we are, and we shall be enjoying these sessions, and gentlemen, because basically, yeah. So lecture number 24, yeah, lecture number 24, what do we have over here? Audit assertions and substantive testing. Audit assertions and substantive testing. Now, ladies and gentlemen, it will be very important for you to know, first of all, what an assertion is. I would want to give you 1 minute, get your search engines, could be Google, it could be an AI engine, look for the word audit assertions, and they give me the very best definitions of this. What is an audit assertion? I would want to read from you. What is an audit assertion? Or management assertion. Yeah, others can look for management assertions. Yeah, I'm waiting to hear from you, ladies and gentlemen, my great students. My great students, I'm waiting to hear from you. What is an assertion? What is an assertion? So whenever you hear the word assertion being thrown anywhere, to assert is to stamp, is to, in this case here, stamp some facts. Yeah, you are authoritatively giving some facts here. You're authoritatively giving some facts. So for example, the management will come and give us financial statements. When they give us financial statements, they are stamping authority and they're saying, you know what, our financial statements are accurate. Our financial statements are accurate. Trust you me, as an auditor, I will not be able to trust that. I won't be able to trust that. I won't be able to trust that because I know in most cases, these directors are there to defend their interests, protect their interests. So an assertion, ladies and gentlemen, is a claim. It is a representation made by management regarding accuracy and the completeness of their financial statements, their claims. They are saying that our financial statements are accurate, but at the end of the day, ladies and gentlemen, they are not accurate. If you remember when we introduced, ladies and gentlemen, this particular subject called audit and assurance, I told you how this thing began. Why auditing? Why should we, in this case here, call in an auditor? You are supposed to know that audit, basically, there are three parties involved. We have the owners of the business who will assign us the job. The shareholders, they'll assign us the job. And then now we have, in this case, here, shareholders. So we have the auditors, number two. And then now we have the managers of the company. So in most cases, the managers of this company would want to steal. They want to steal resources belonging to the shareholders. And I gave you an example of one of those institutions that left Kenya, Barclays Bank. If, for example, we come together, like 1 million of us, we contribute money, and then we start a company called Barclays. We can't stay in Nairobi offices here to run the bank. We'll need, out of these 1 million people, to appoint like just 10 of us in the name of directors who will be able now to manage Barclays on our behalf. We, the direct or shareholders, who are now going home because there is no room for us in Nairobi here at the headquarters. So chances are, because human beings, you are very, very greedy, chances are the 10 directors who have been appointed may want to steal. So these 10 directors, they'll be told here to do a lot of reports. I've told you in auditing, in financial reporting, there are a lot of reports. They'll be told in this case here, like on a monthly basis, they're doing management reports. At the end of the year, at the end of the quarter, at the end of the year, they give us what we call financial statements. So when they give us these financial statements, even if, ladies and gentlemen, they have stolen, they would want still to stamp down some facts here on us. Force, in this case here, everybody in the organization to believe that they have done the right thing. They have produced accurate reports. But now remember, my friends, as auditors, we need to be very, very skeptical. It's called professional skepticism, where you doubt everything that these people are telling you. When they tell you through their assertions that the financial statements are accurate, you tell them, not a problem, let me do substantive tests. So I just wanted to introduce that. And then now I share my screen here. Audit assertions and the substantive what here? Testing. This is basically section D of your AAA-CPA-ACCA audit and assurance syllabus. Yeah. So remember, we have planning, we have execution. So now I'm doing the execution. Execution, we have got what we call test of internal controls that I've done. And now we are going to the last area, which is now the audit substantive tests. Introduction. We are now in the process of auditing. You know, the other times, we were basically looking at the regulation, the framework, testing internal controls. But now here we are going to test, ladies and gentlemen, now the numbers in the financial statements to see whether they are okay. So we are now in section D of the syllabus. This is a high weight. If you see students who are failing audit and assurance at the intermediate level and at the advanced level, who are failing like thrice or 4 times, they don't understand substantive testing. the one that many students struggle with. So I want to recap with this stage. So stage 1 is the audit framework. As an audit, of course, there is a framework that we normally follow whenever we are auditing, where we have ISA, International Standards on Auditing, ethics, independence. Then we go to the planning audit here, section B, where we look at the identifying risk, materiality. I told you materiality, we have what we call overall materiality and the performance materiality. And then we have here audit focus, the risky areas. And then we go to execution. Execution has got 2, internal control, substantive testing. You can see now I'm almost finishing my syllabus. Internal control, we test the process controls. But now in substantive testing, which is D, before I start finishing the syllabus, we shall verify the figures using the evidence that we collect. Yeah, so now we are here. It's always very important for you to know where we are in the syllabus. All right, remember we have done the first 23 lessons. Yeah, this is the 24th lesson. So section D is the heart of the audit, where the rubber hits the road. For those of you who have ever flew, yeah, with these great helicopters up there, not helicopters, but just a good, like Boeing 777. And of course, in this case here, you go to the landing pad. Up there, you are really, really happy. But when this rubber, it's a wheel, there are wheels down there. When they meet the road like this, we even see sparks coming up. So we expect turbulence there. So section D is the heart of the audit, where the rubber hits the road. You are no longer asking what to test or how the client controls work. No, now you are doing the testing. The importance of assertions. Assertions are really, really important. It's good to know, ladies and gentlemen, in this case here, what the directors are thinking. Because remember, the directors are there. This could be like the Man U players. And then we have, in this case here, the auditor on the other side, Arsenal players. Yeah. So in this case here, we need to know the minds of these guys for us to be able to execute the audit very well. Otherwise, they'll score so many goals on us, right? Yeah, so it's important to understand the assertions the way we understand the back of our hands, we as auditors. What are the claims of these directors? What are they claiming? Are they claiming that their accounts are complete? Because, these managers, whenever they're doing their financial statements, they would want to cheat us. Actually, in some cases, they even produce like 2 sets of financial statements. Financial statements going to KRA, those ones will not be complete in terms of sales, because they would want to understate. They would want to understate sales, to underdeclare sales, so that the profits will be underdeclared, so that they pay little taxes. Yeah. But when it comes, for example, like when they want to borrow loans, and then the bank tells them, hey, give us your income statement, they would want to push the sales like even 4 times up. So then I have to be aware, what are these guys thinking? What are these Man U guys thinking? If I don't sit down and watch their game in advance with our coach, we as Arsenal players, chances are we shall lose. And that is why as an auditor, you must always plan very well. Before you go meeting these guys, you need an overall audit strategy. You need a detailed audit program. You must sit somewhere, try first of all to do what we call understanding your client. Otherwise, you are going to lose this game. You can even score against yourself, you can imagine, if you don't plan very, very well. Now, please listen, ladies and gentlemen, and listen to me very, very carefully. Without assertions, auditing is like playing football without a goalpost. Yeah, the other day I took my children somewhere, and there were girls in this case who were playing some ball. You see now they're playing ball. Girls are not very many girls are very, very keen with balls. So they're just playing balls. In this case here, eating. It's football. But you see there are no goalposts. So you're simply running around. I mean, you don't know. Are you making any progress in terms of football if you're running without scoring goals? Where there are no goalposts, of course, you can never score. All right. The same case for an auditor. If in this case here you are starting to do your auditing without knowing the assertions that you're testing, then automatically you do not have any goalpost. You shall not be able to score. So without assertions, I repeat this, and I will also repeat it here in part 3. Without assertions, auditing is like playing football without a goalpost. You may run around and yes, kick the ball beautifully. But how do you know you have scored honestly if there are no goalposts? In auditing, assertions are your goalposts. They give meaning to your procedures, audit procedures. Each financial statement item has assertions that must be tested and verified. Football analogy, I like repeating this because I know when I take auditing with football together, you guys, given that most of you are Gen Zs, you tend to understand much better. So imagine playing football with no goalpost. You might play very well. Like you guys know of some teams that in terms of football control, they are very, very good, but they never get to score. They never get to win. Is there somebody who can guess which team is that? I mean, everybody would want to really watch how they are dancing and dribbling and doing that ball nicely. But whenever it comes to scoring, they are nowhere. Anybody who could be knowing that team, in this case here, these premiers and whatever, let me see whether my students watch football. Because for this subject, I would want you to know football. FM, we don't talk about. Yeah, I don't know. Ako is saying, Man U. I want to hear that team. Be free. Talk to me. iPhone is also saying it's Man U. The best game, but whenever it comes, in this case here, to scoring, they are defeated by even the simplest of the teams. Simplest of the teams. I don't want Man U supporters to feel bad. I believe that Man U supporters equally will say it is what year Arsenal, which has never won. Concept of next season, next season, next season, but we shall overcome. We shall overcome. We are not biased. We are here to study audit and assurance. Yeah. So imagine playing football with no goalpost. You might play very well, but you can't score. And therefore, there is no objective. You're just running around like a headless chicken. A smart auditor must know where the goalposts are. And the goalposts here are the assertions. And the aim, each procedure, those procedures that we shall be calling R, A, E, O, U, the old procedures shall be calling them R, A, E, O, U. I is analytical procedures. A is inquiry and third-party confirmations. Inquiry and third-party confirmations. We have inspections. Then we have, in this case here, recalculation and re-performance. R, analytical. A, inquiry. I'll have to inquire quite a lot from many people internally and externally. I is inspection. Then we have O, observation. The last one, U, at least U, we have recalculation. There is a U in between, and re-performance. Each one of those audit procedures must be aiming a particular assertion. If you throw a procedure, an audit procedure, without knowing the assertion that you're going to be working on, is akin to simply shooting an arrow into darkness. So we must be very good, ladies and gentlemen, with this concept of what here, assertions, because assertions are really our goalposts here. So a smart auditor must know where the goalposts are, the assertions, and aim each procedure at one of them. Categories of assertions. Assertions differ slightly depending on whether the item is in the profit or loss or statement of financial position. For P&L items, we shall be using this acronym, the OC-CAP. OC-CAP. If you wish, you can use this acronym as well. Yeah. Only correct classes are posted. But for me, whenever I see OC, because I have also some military background, given that my father was in the military for over 30 years, engineers battalion, so I know OC, like IC, yeah, OC, and then the cap. Whenever I see OC cap, then I will be able to know that these are assertions of P&L. Where you can see the first O stands for occurrence. Did the transaction really happen? When you tell us, ladies and gentlemen, like now sales, we sold goods worth 10 million. I have to confirm, is it true that there were goods sold worth 10 million sold to Mr. A? I will have to find out as an auditor whether this happened. Accuracy. Was the amount recorded accurately? Or is there somebody who is trying to under-declare or over-declare? I mean, if, for example, you are at KRA and people are coming with imported goods, people may want to under-declare the value. Yeah, so the accuracy is really, really an important assertion here, all right, for this A. All right. After that, ladies and gentlemen, we have completeness. Completeness are all relevant transactions included. Yeah, are all relevant transactions included. Because like now, this completeness, you will see how we'll be testing this completeness. So the completeness, for example, somebody at RCM College will place an order on 30th of December, 2025. We've just placed an order from our suppliers. Give us these goods. You see, the goods have not arrived by this 30th December or 31st December. They haven't arrived yet. They'll be arriving in 2026. All right. All right. So you are going to see how that particular example will be assisting us to look at what we call completeness and cut off. Completeness and cut off. Very, very important. Because, ladies and gentlemen, there are goods in this case that were brought, for example, in 2025. Yeah. But these people, for example, they would want to push these goods to next year. So it means your sales report for this year is not complete. There are things that have been left out. And in terms of cut off, you see, cut off, we must always have 2025 being cut off from 2026. All transactions that belong to 2024 should be reported in 2024. Should be reported in 2024, like that. Yeah. So in this case here, we have OC cap. OC cap for transactions, for assertions of the P&L. Once you understand that, you will never go wrong. You will never go wrong. So we have here completeness, are all relevant transactions included. Presentation, is it shown in the correct format and the classification? Ladies and gentlemen, there are people who purchase goods. They purchase, for example, a motor vehicle. Instead of taking these purchases, the amount, yeah, opening an asset called a motor vehicle, then they debit there. They will take this motor vehicle's amount and put it under purchases. Wrong classification. Yeah. So it means that this particular purchases item has not been presented. Even when you sell, there are people who will sell, they have received money, and then they book this money received in a different class. So I have to ask myself, fine, everything is complete. Things are accurate here, ladies and gentlemen. They have occurred, but have they been presented properly on the face of the financial statements? OC cap. OC cap, very, very important. Then the cutoff, was it recorded in the correct accounting period? Yeah, so for statement of financial position items, we shall use the 𝐉CRP, or what they're using here, these names here, every value can reflect properly. I don't like it that way. I like looking at 𝐉CRP. So remember, statement of financial positions, what are we looking at? We're looking at things like assets, liabilities, equities. So like, for example, this E stands for existence. When you tell me that you have an asset by the end of the year, I will have to ask myself, for sure, that asset that is in your books, does it exist? So I would want even to do what we call observation. Observation, I'll tell you, please show me where this particular asset is parked so that I can just go and see like that. And then, of course, once I see it, I'll be able to ask for rights and obligations. If you're telling me that that vehicle that I've seen outside there is yours, could you kindly then tell me, or rather show me its logbook for me to know that it is rightfully yours? Yeah. So does the entity own the asset or owe the liability? Completeness, have all assets stroke liabilities here been included? Then we have your valuation and allocation. Are the balances accurately measured? Are the balances accurately measured, including depreciation, impairment, or provisions? Presentation, are the balances properly classified and disclosed? Yeah. Understanding each assertion. Understanding each assertion. Understanding each assertion. Great. Great. Understanding each assertion. You're almost finishing. So understanding each assertion, occurrence, P and L. Did this transaction really happen? Yeah. Example, for revenue, check in this case here the dispatch notes given. You're saying in this case here you sold goods. You've been able to earn some revenue. So where is evidence to show that the goods were dispatched from the organization? So check dispatch notes or even sales invoices to confirm a real sale occurred. This is very important, especially for those of you who will be working in audit firms or for some institutions like Kenya Revenue Authority. Yeah. Check dispatch notes or sales invoices to confirm a real sale occurred. Then we have accuracy. Was the amount recorded correctly? Was the amount recorded correctly? Example, to know whether it was recorded correctly, match invoice value to customer order. Recalculate based on unit price and quantity. Yeah, so in this case here, we are matching, remember, we've raised an invoice. The customer had placed an order earlier on with us. So when the customer placed an order, of course, at the end of the day, we expect the order to have some figures, some agreements, because when the customer places an order, we must always reply back to their emails, or depending on the system that you're using, to confirm with them whether we have understood. And of course, use that opportunity to give them the pricing. Once they say yes, then of course we shall be able to make a sale. When we make a sale, we expect to invoice. So then we have the invoice, we have in this case here customer order, I will have to match that. Where it becomes very good, I can even look at the general ledger. How much do we have in the general ledger, GL, for that particular sale, for the sales? All right. Recalculate based on the unit price. This person ordered 10 units. Each unit is going for 5 bob. Completeness, have all items that should be recorded been included? Yeah, not completeness. You do what we call from floor to GL. Yeah, from floor to general ledger. General ledger is a ceiling. So the floor here. So here for completeness, you'd want everything that was supposed to be in this room to be included. So for completeness, you have to do quite a lot of audit tests, for you to be able to ascertain the assertion of completeness. Yeah, examples, select assets physically and trace them to the register. Completeness of assets. Ask for the property, plant, and equipment register. All right. They're saying they've got tractors. Get to see them. Get to inspect documents. All right. Number 2, you check the bank statement, for example, for January the following year, right? The month after the year end, say January 2025, if you're auditing 2024 books. Look for payments made in January. So for example, on the 5th of January, the company paid Kenya shillings 50,000 to a supplier. So I would want to see whether this 50,000 was included in December. Because the fact that it has been paid in January, it doesn't mean that it is a January expenditure. No, we get goods on credit and we accrue them. So you need to ask yourself, what was the payment for? Was it for goods or services received in December, but you are paying in January? If yes, then the liability should have been recorded in December 2024 as an accrual, even if the actual payment happened in January. If it wasn't recorded in December, that means that the financial statements understate liabilities, which is a completeness issue. Ladies and gentlemen, when we are doing practical auditing, normally whatever happens in January, we really, look at it critically to be able to test, for example, their completeness and cutoff procedures. Yeah. Because remember, we don't have, ladies and gentlemen, to pay for a liability for us to accrue it. No, so long as you have contracted, yeah, somebody has started delivering services in December, then that particular item should have been booked as a liability in 2024. The fact that you haven't paid for it means it is accrued. It will be paid in 2025 January or whichever month, but it was accrued nicely and kept in the register of liabilities of this organization in 2024. All right, ladies and gentlemen. So we have cut off. Cut off is for profit and loss only. Was the transaction recorded in the correct period? Example, check sales near year end. Goods shipped on December 30th must be recorded in 2024, not 2025. Yeah. So goods shipped on December, even December 31st, those are goods. That's a liability for this organization, or rather if it's sales, not liability, but this sales should have been booked in 2024. So long as you have shipped them, they have left the organization. Yeah. Key point, completeness asks, are all 2024 transactions included? That's completeness. Cutoff asks, are only 2024 transactions included? Yeah, because cutoff, we are cutting off transactions of 2023 and the transaction of 2025, we are only left with the transactions of 2024 as the cutoff mark. We should understand this when we go to the practical aspects, ladies and gentlemen. We have presentation and disclosure. Is it properly disclosed and correctly classified? Examples are trade receivables and payables shown separately. Are contingent liabilities disclosed clearly? Yeah. Existence, statement of financial position only. Do the assets and liabilities really exist at the year end? Examples, fixed assets. Go and inspect machinery. Receivables, do what we call receivable circularization. You send confirmation letters to the customers to confirm that for sure they owe us. Send confirmation letters. We have rights and obligations, statement of financial position only. Does the entity own the asset or owe the liability? Examples for PPE, check purchase agreements. Inventory and consignment, entity might not have ownership. Yeah, inventory on consignment. If you remember consignment accounts. Yeah, you know, for example, ladies and gentlemen, under consignment, we could be consigned as RCM. We have in this case here, for example, a great motor vehicle company that sends, like, say, 5 vehicles to our warehouses here in Nairobi for onward selling. Onward selling, if you are a motor vehicle company. So you see, even if these motor vehicles exist in our premises, we don't own them. We don't have logbooks to show that we own them. These vehicles are assets of another entity. So under rights and obligations, we need these documentations. We need purchase agreements. We need logbooks. We need title deeds, etc. Valuation, are the balances accurate and recoverable? Yeah, inventory, check net realizable value versus cost. Yeah, check. Yeah, receivables, review aged balances and impairment what year provisions. I'll be explaining what this means, because, ladies and gentlemen, receivables, you could have receivables of customers who have been declared bankrupt. So then, has proper valuation happened? It can only be said to have happened if those impairments were subtracted. PPE, for proper valuation, step by step, ladies and gentlemen, logic here. What are the balance or transactions? Is it revenue? What is the balance or transaction? In our financial statements, what balances do we have there? Closing balances and transactions here. Is it a P&L or a statement of financial position item? Choose the right assertions. Remember, we have assertions for P&L, the OC up, Very important. I hope you'll be able to remember them. And then we have the SFP item here, what we have called EV CRP. Yeah, very, very important acronyms. Real world document to each assertion, which of course, yeah, my internet, I'm being told, is unstable. Yeah, like now here I've been able to tell you like what happens here. Develop audit procedures for each assertion. So the procedure, is it to inspect? Is it to do these inquiries and third-party confirmations? What is it really about this? What is it really about this? All right. Sorry, let me check. Yeah, great. Quick reference, we've said, ladies and gentlemen, for revenue purchases, you'll be able to see anything that is P&L. Always, you should always be thinking about what here the OC cap thing, all this P&L, OC cap. Whenever it comes to SFP assertions, you should always be thinking of EV, yeah, EV CRP. Very, very important, really. I don't have to belabor about this. So exam tip, how to design audit procedures for assertions. Yeah, example, audit of revenue. Assertion, they are here. It's OC COP, occurrence. Inspect dispatch notes, match to invoices. Accuracy, we should always talk about you as an auditor recalculating. Yeah, it's going to be price times quantity, you must recalculate. So recalculate the invoice values and agree to sales ledger. You do what we call casting. Completeness, select dispatch notes and trace them to sales ledgers to see whether your sales ledger is complete. Vouch them using the dispatch notes. Cut off, inspect dispatch notes before and after year end to confirm correct period. Presentation, check classification of sales in trial balance and financial statements like that. So, ladies and gentlemen, that marks the end to lesson number 24. So I would want to start lesson number 25, which is really, really short. You can see lesson number 25 is only 2 pages. So I don't know whether I will be able to get a quarter